Now, as expected, Canadians who are carrying a lot of debt are finding that load feels heavier. The Bank of Canada has pushed up its overnight interest rate by 50 basis points to 1.5%. CBC business reporter Jeannie Lee is on this story for us. So this, Jeannie, is the third time the bank has raised rates in 3 months. What difference will this latest hike make?
Well, we'll definitely feel the difference, Arthi, when the prime lending rate at the chartered banks go up based on this Bank of Canada move. That tends to follow any kind of Bank of Canada announcement. The chartered banks will then announce their prime lending rates will go up probably accordingly. So far, none has made the first move yet, but we are watching for that. But no question, anyone who has a lot of debt, the more debt you have, obviously the more you will feel this latest rate hike. Don't forget that things like variable rate mortgages, the payments might not change, but the interest portion goes up, meaning less of your payment goes towards your principal. Anyone with an adjustable rate mortgage will feel this immediately when it comes to their payments. And of course, those popular lines of credit, even more popular during the pandemic, those payments will definitely go up. So here's what happened. If you look at this graph, I marked out for you exactly how the key benchmark rate at the Bank of Canada has performed in the last year and a half or so. Remember, rates were at rock bottom, 0.25% in the first 2 years of the pandemic, slashed there to emergency levels to avoid a major recession. And of course, that fanned inflation. And so in March, a little rate hike, a typical one of 25 basis points. And then since then, two in a row hikes of 50 basis points. So that 1.5% is 6 times what it was just 13 weeks ago. So here's a look at an example. I picked one out of the air, $100,000. Let's say you owe that. So for every $100,000 you owe, the interest portion, which may vary depending on the product that you're borrowing and the rate that you have, the interest portion that is caused by these rate hikes by the Bank of Canada basically goes from $250 a year to $1,500 a year. So it's gone up by a factor of 6. That starts to hurt, especially when you consider that a lot of people owe way more than $100,000, Arthi.
And Jeannie, that comparison is already pretty scary to look at for those who would be in that situation. The question is, too, how much more should people be bracing for?
You should brace to sweat even more under that debt load, because the Bank of Canada is now on a mission to fight inflation, which we know is at 31-year highs and looks to be pretty stubborn at these levels. And so you make it more expensive to borrow money. That tends to discourage demand. That tends to then dampen prices, and that's how you bring down inflation. So here's what the bank is saying about that specifically. The pace of further increases to the policy rate will be guided by the bank's ongoing assessment of the economy and inflation. And the Governing Council is prepared to act more forcefully if needed. So there's your warning, more forcefully. A lot of economists expect the bank to keep raising until that benchmark rate, 1.5% today, goes up to about 2.5%. So there's still quite a lot of more sweat, shall we say, to come.
All righty, Jeannie. Thanks for this. That is Jeannie Lee reporting. So, of course, as we heard, interest rates are rising, and so is the cost of living. Many are struggling, and that may be particularly true for younger generations. How to navigate these challenging times? For more on that, we're joined now by Jessica Moorhouse. She's a personal finance podcaster and an accredited financial counselor in Toronto. She's here to share some tips with us. Jessica, thank you for joining us.
Thanks for having me.
As we just heard, the Bank of Canada has raised interest rates 3 times recently, and there has been indication that they could keep going higher. How should people prepare?
Yeah, so I know people are feeling the pinch, and as was said earlier, you're going to continue to feel this pinch, maybe a little bit bigger of a pinch moving forward in the next couple of months and the rest of the year. So, how can we all prepare? I think first off, taking a look at what is going on with your money. I think lots of us have no idea really where every dollar is going, and so I always encourage people take this as your, signal to take a look at your spending, your budget, crack open that Excel spreadsheet, put everything in there to see, is there something that we can cut out so we can now make room and kind of ease that cash flow? Again, lots of people are feeling the pinch, myself included. I'm one of those, homeowners that does have a variable mortgage rate. And so I'm definitely kind of concerned. And so the best thing that we can do is taking a look at what's happening and what can we actionably do. Believe me, there is always something in your budget or your spending that you can cut that you will not miss. I always kind of tell people, instead of thinking about what you should, cut out based off what, popular opinion, take a look at what you actually value, what you need, and what you can easily live without. That is a great, easy way that you can kind of start freeing up some cash so you can afford, things that are more expensive and kind of these higher interest rates.
So then give us some examples. Jessica, what have you been doing differently?
Well, I will say I'm definitely kind of taking that signal from the Bank of Canada to ease up on any of my borrowing and, focusing on spending. And so if anyone has debt, for example, especially one that is really tied to the key interest rate and the prime rate, this may be your kind of opportunity to take a look at, hey, how can we, pay this debt off a little bit quicker? Maybe you didn't have necessarily a firm, debt repayment plan. This would be the time to do it, especially with those lines of credit that I think people will feel a bigger impact with than maybe your kind of 30-year mortgage. Again, it won't really affect your day-to-day. It affects the principal, not your payments, those mortgages. But for, your line of credit, this may be, something that you want to focus on paying off sooner rather than later. So that's definitely one kind of suggestion I would have for people who are dealing with debt. But otherwise, I think a lot of people are wondering what should they do with their money. And well, the Bank of Canada wants us to stop borrowing as much and start saving so we can get inflation back on track into that kind of neutral level. And so, one good thing out of this interest rate hike that most people, I feel like, don't really think too much about is savings rates, or savings interest rates rather, are going up. Same with GIC. So, at least you can earn a little bit more on, interest on your savings, and hopefully, maybe, again, this is another opportunity to take a look at your budget, see what do we want to save for, and what bank is offering the best interest rates now. Maybe this is a good way to do some shopping around.
You mentioned, Jessica, that you're also a homeowner, and so mortgage is something that you're thinking about. Anyone who has one certainly is looking at that as we look at the rate hike. So I guess part of the question here is, if people are buying a home now, or let's say they're refinancing the mortgage that they have, how should they approach that at this stage?
Absolutely. Well, if you really don't have a huge risk tolerance, then I think a fixed rate will make more sense for you because you know exactly what's going to happen for the entire term of your mortgage. But for me, I knew that there was a chance that interest rates were going to continue to go up throughout 2022. And so that is why I chose a variable. I knew the risk, but I knew also historically long term, if you choose a variable rate, you could save a lot more money. And so that's what I did. But again, you kind of have to understand what your risk tolerance is. If hearing these headlines every couple months is giving you anxiety, maybe a fixed rate makes more sense for you.
So now in this sort of post-pandemic, semi-post-pandemic life that we're existing in, the question is, what has changed compared to if we were in this scenario pre-pandemic or at the height of the pandemic, for example?
I'd say one thing that, people may not really realize is we are in a much better position now than a couple of years ago, especially in terms of earning more income. So again, one way to combat, interest rates rising and high inflation is to earn more money. And, it may not seem like, oh, it's so easy to make extra money, but it actually is so much easier, especially when you compare now to the Great Recession, when it was really tough to find work. Now, there's so many more opportunities with apps and just, if you have a skill, you can go on Upwork and sell your services. I know so many people lost their jobs, people that I know personally that lost their jobs due to the pandemic. And they've completely changed careers and were able to do that from the comfort of their own home or start their own business just from their computer. So I always kind of like to, share, although there's, it's kind of a tough time for lots of people, we're all feeling it. There's also kind of a brighter side. There are some opportunities out there. You just kind of have to look for them.
And so finally, looking ahead, how long is something like this going to last? People, of course, want to be able to plan for a certain point in time. Does this change, Sue? Later?
I don't think anytime soon. I certainly don't have a crystal ball, but I would expect this to continue throughout the rest of the year. That's certainly what I'm kind of telling myself. I think it's always good to have, realistic expectations. So, we heard that there's a good possibility, a likelihood that interest rates will continue to go up. I think that's definitely going to happen, in my opinion. And I think we're going to continue to feel this pinch throughout the year. And hopefully, as we see inflation go down, which is the whole purpose of interest rates going up, we will start to see a decline, hopefully in 2023. So that's what I hope.
Okay, there you have it, folks. Thanks for this, Jessica. That is Jessica Moorhouse. She is a personal finance podcaster and an accredited financial counselor. We reached her today in Toronto. Thank you for joining us.
Thank you.